What's going on, guys? Welcome back to another video. In this video, I've got another AMC update to bring all of you this evening. So I apologize for not being able to go live tonight. I do have a lot of schoolwork that I have to catch up on. I'm in my senior year of college. I know I don't really want to have to do all of the schoolwork, but I have to do it. We do have some really important information, though, that we do need to get out to everybody this evening. So what we're going to be covering in this video is a brief Ortex short interest and utilization update coming into the end of the day. We have some very interesting things going on with the numbers that we are seeing that I want to make sure everybody understands. Now, in addition to this, we have seen Gary Gensler basically testify in front of some government committee today. But something very interesting that came out of this hearing is that the SEC is essentially going after Citadel and their business model right now. We're going to go over that situation in depth with the current information that we have at the current time. And in addition to this, I've seen a lot of people over and over anytime somebody comes out and says that some large institution is making a big purchase of AMC shares, as reported by their 13F filings, everybody always says, well, they might just be loaning out the shares to shorts for them to essentially attack our position. Now, we're going to go over exactly how that would work and where we are at in the current time in that timeline that we would see from when the buy would happen, when the shares would go out on loan and shorted, and where we are at the current time. And I'll give you a hint, it's very, very bullish for what we have going forward. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And the more people that we have staying up to date with accurate AMC information, the stronger our community becomes. And if you want to see more videos like this, make sure you hit that subscribe button. So we did have a very significant red day for AMC today. This was not something that we were expecting. I think a lot of us were expecting AMC to kind of have a slight red day this week or a consolidation day before we came back up to the upside. But again, this is why we talk about the broad market on this channel so much and the situation that we have unraveling with our overall economy, because when we see broad market sell-offs, it is going to impact AMC. We knew these inflation numbers were coming out and how they could potentially affect the broad market. Now, I know a lot of people bring up the concept that AMC has a negative beta, but what you have to think about is that since AMC is such a heavily manipulated stock, the hedge funds that are over leveraged on these short positions are not going to see the market come down, AMC start to come down, a negative beta, and think, well, we're not going to short this just because of this one data metric. They are going to continually try to short the stock in order to get the price down to a low enough level so they can cover their short positions and get out with minimal losses. Do I think that's going to end up happening? Absolutely not. We had one significant red day. Everything is okay. We are still on a good uptrend. Now, when we come over to Ortex, we can see that the current estimate for the short interest, 19.26%, down about 3.3% today. That's kind of an interesting number to see, but we did see 6.6 million shares returned today with only 2.9 million borrowed. Now, 2.9 million in terms of borrowed shares is significant, but it's not enough to push the price down that much. What has most likely happened is that a lot of these shares that have been going out on loan over the last week or two haven't been sold into the market. So what we're seeing here is that these shares can go out on loan. These shorts are paying the borrow fee rate, but they're not selling them into the open market yet to enter that short position. They might have saw some market weakness today and decided to enter their shorts right here. They could have been a short-term short position, or they're actually fundamentally short on AMC. We'll see what happens. Good luck to them. I don't think their position is going to be very profitable in the long run, but we will see. Now, when we come over to Stonko Tracker right here, because of this significant red day, we did see a significant decrease in the calls expiring in the money. 137,000 call contracts are now in the money for AMC. Now, when we see the share price of AMC go down and we look at what's going on the option chain, when these contracts run out of the money and these market makers have already hedged for the contracts previously running in the money, they sell off those shares. It is called unhedging and adds to the selling volume. Now, what also happens is that when the put contracts run in the money, in order to efficiently hedge those puts, the market makers either buy offsetting put contracts or they just short direct shares of the stock. So it just adds fuel to the fire, these options, when they run in the money or out of the money. Now let's get into this SEC and Citadel situation. When we come over to this Yahoo Finance article, Gensler zeroes in on Citadel Securities as the SEC considers payment for order flow ban. Wall Street's top cops said Tuesday that the dominance of Citadel Securities in the business of routing order flow may not be giving retail investors the best deal. The U.S. SEC Chair Gary Gensler told the Senate Banking Committee that he's concerned about Citadel Securities' 47% market share over all U.S. listed retail volume. Virtue, another wholesaler, controls about 25 to 30%. I'm pro-competition, and I'm not sure the payment for order flow system really is the best competitive landscape. We can see here the SEC has not ruled out the possibility of a full ban. And coming down a little bit further, I think the inherent conflicts of payment for order flow and rebates on the stock exchanges both may make our markets less efficient. So a lot of people have been saying that the SEC is not doing anything. But from GameStop's most recent quarterly report and the comments that Gary Gensler has made in this Senate Banking Committee meeting, I think everybody needs to rethink their comments publicly about what they're saying about the SEC, because when you think about it, one, they're not going to come out and just tell you what they're investigating, and two, these investigations take a lot of time to play out. Now, all of that being said about Gary Gensler's comments about payment for order flow, let's take some shots at everybody's least favorite brokerage platform. When we come over to this article right here, this came out a couple of days ago and we went over this. Robinhood's chief legal officer says the SEC won't ban payment for order flow. He says that the SEC is going to arrive at the conclusion that payment for order flow is undoubtedly an amazingly good thing for retail investors, and they're not going to ban it, said Robinhood's chief legal officer Dan Gallagher, who was the agency's commissioner from 2011 to 2015. Now, when we think about the comments that Gary Gensler has just made and this comment from Robinhood's chief legal officer, it just makes everything at Robinhood just look super silly. Obviously, the SEC is going to be investigating this because it is blatantly obvious how inherently terrible this payment for order flow system is for our broad markets. Now, let's talk about this concept of a lot of these institutions who are buying shares of AMC, potentially loaning these shares out. So let's just take BlackRock for an example. When we come over to Fintel right here, we can see that BlackRock holds about 30 million shares at the current time, and they increased their share position in the last quarter. Remember, the effective date of these purchases is at the end of June. So anytime you see somebody posting something that this institution bought shares, this happened in the second quarter. We have no idea what these institutions are doing at the current time, which is also why some people may be a little bit worried that institutions are selling or they're loaning out shares. But BlackRock increased their position in the second quarter by 11.51%. Now, this is a good thing. This does show that institutions are very bullish on the prospects of AMC going a lot higher than $77 a share, because when we consider where AMC was at in the beginning of the second quarter and at the end of the second quarter, it's about $8, and then they closed at around $55 in the quarter. So the fact that these institutions are continuously adding to their positions, and right now we closed the trading day today at about $47.30, it doesn't make a lot of sense for these institutions to sell their positions now when they were continuously buying the stock when it was at a lot higher levels. But let's get into this concept of the institutions loaning out their shares. Even if BlackRock and these other institutions like Vanguard or Renaissance were actually loaning out these shares, most likely they have already been sold into the market. So what does that mean for us at the current time? Well, if they've already been sold into the market, we've already seen the effects of the selling pressure, and we did see a lot of volatility and downward pressure in July and August. But what we have to look at here is this comment made by BNY Mellon about lending securities. Right here, lenders can recall their securities whenever they want, for whatever reason they want, and they do not have to provide an explanation. All they need to do is ensure the request is made in good time so that we do not interrupt their investment life cycle. So what they're saying here is that when you loan out these securities, you can just recall them back at any time. So let's just do a brief example. So let's say institution A loans to a hedge fund and they sell their shares on the open market. Well, the institution that loaned their shares can force the other institution, the hedge fund, to buy buy back those shares and return them at any time they see fit. So what we're looking at here is that these large institutions, if they're loaning out shares, they hold the key almost to starting off this squeeze with their ability to perform one of these forced share recalls. Now, are they going to do that? Most likely not, because that could be seen as market manipulation. But they don't have to recall their entire position. They could recall a portion of the shares that have been loaned out, and that could cause gamma squeeze, FOMO rally, and even more shorts covering their positions who did not get forcibly recalled. So that is mainly going to wrap up this evening update on AMC. If you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you want to see more videos like this, make sure you hit that subscribe button. So I hope you guys had a great day, and I'll see you guys in the next video.